A stock market crashes, people panic. Experts say, give it time, 2 years, maybe five. But what if the crash never truly ends? What if decades pass and the market never fully recovers? In 1990, Japan's stock market collapsed, and for more than 30 years, it stayed broken. This crash never really ended. This is the story of Japan's asset bubble collapse, one of the most devastating and misunderstood financial disasters in modern history. In the 1980s, Japan looked unstoppable. Its companies dominated the world: Sony, Toyota, Panasonic, Honda, Nintendo. Japanese products were everywhere, and they were cheaper, better, and more reliable. By 1989, Japan had the second largest economy on Earth, the Nikkei 225 index. Its main stock market reached nearly 39,000 points. Japanese corporations were buying up American landmarks, from Rockefeller Center to Hollywood movie studios. At one point, analysts seriously believed Japan would overtake the United States as the world's #1 economy. Tokyo became the most expensive city on the planet. Land prices reached absolutely absurd levels. There was a popular joke at the time that said the land under Tokyo's Imperial Palace was worth more than all the real estate in California. It sounded ridiculous, but it was almost true. Japan was convinced it had discovered a new economic model, one where prices only ever went up. That single belief would destroy everything. So how did this happen? To keep the economy growing, Japan's central bank kept interest rates extremely low. Cheap money flooded the system. Banks began lending aggressively to real estate developers, to corporations, and to individual investors. Loans were given out with almost no risk assessment. Why? Because asset prices, especially land and stocks, were rising so fast that banks believed even if the borrowers failed, the collateral would be worth more tomorrow. This single assumption created the disaster. Real estate prices exploded. Stock prices followed right behind them. Soon, companies stopped focusing on productivity and innovation. Instead, they started to speculate. Businesses were borrowing massive amounts of money, not to build better products, but to buy stocks and land. Japan wasn't really growing anymore. It was gambling with borrowed money. By the end of 1989, the bubble was at its peak. Then the Bank of Japan did the unthinkable. It raised interest rates. The goal was simple: slow down the speculation and cool off the overheating asset prices. But the bubble was just too large. Higher interest rates meant loans suddenly became expensive, and all that debt became dangerous. Asset prices stopped rising, and once prices stopped going up, the panic began. Investors rushed to sell, stock prices collapsed, real estate values plunged. By 1992, the Nikkei had lost over 60% of its value. Trillions of dollars in wealth simply vanished. But unlike other market crashes, Japan never bounced back. And this is where Japan's story becomes unique. Instead of letting the bad banks fail, the government protected them. These banks were full of non-performing loans, debt that they knew would never be repaid. But rather than writing them off and admitting the losses, the banks pretended everything was fine. They even kept lending more money to bankrupt companies, just to keep them afloat and avoid having to declare the original loans as losses. These businesses became known as zombie companies. They were alive on paper but dead in reality. They couldn't innovate, they couldn't grow, they could barely pay the interest on their loans. This practice destroyed Japan's economy in slow motion. Innovation collapsed. Productivity stalled. New, young companies couldn't get the capital they needed to grow because it was all tied up propping up these zombies. The economy didn't crash violently. It rotted away quietly from the inside. What followed is now known as Japan's lost decades. From the 1990s all the way through the 2010s, economic growth stayed near zero. Wages stagnated, consumer confidence disappeared. People stopped spending money, and a dangerous cycle called deflation took over. Prices started falling, but that wasn't good news. It created a psychological trap. Why buy something today if you know it will be cheaper tomorrow? Fear replaced ambition. Saving replaced investing. An entire generation grew up without ever seeing real, sustained economic growth. The most shocking fact of all? The Nikkei index, which peaked in 1989, did not return to that level for over 3 decades. Even today, when you adjust for inflation, many investors who bought in at the peak in 1989 are still at a loss. Compare this with other major crashes. The U.S. market after the 2008 financial crisis, the dot-com crash of 2000, even the COVID crash of 2020, all of them recovered within a few years. Japan didn't, because the problem wasn't just the crash itself. The problem was what came after. Japan's experience taught the world some brutal lessons. Asset bubbles don't just disappear, they explode. Cheap money creates dangerous illusions of wealth, and protecting failed institutions to avoid short-term pain can destroy an economy's long-term potential for growth. It showed that confidence is just as important as capital. Japan survived, but it has arguably never truly healed. Japan's crash isn't just a piece of history. It's a warning. It's a reminder that markets don't always recover quickly, that prosperity can freeze, that the mistakes made during the good times are paid for, sometimes for decades. This wasn't just a crash, it was a financial winter that lasted for 30 years. And once again, the world is swimming in cheap money. So the question isn't, could this happen again? The real question is, where? Thanks for watching. If you found this story interesting, please subscribe for more.